Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Caccera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Caccera.
Welcome in, Joe Caccera with Real Estate Radio Live. Thank you for those that are following the show here on Facebook. We appreciate that very much. And thank you for your continued support for the show over the last 8 years now. We continue to deliver this information to you, and by the way, we're also upgrading. Should have done this a long time ago, but our YouTube channel, we've been posting our podcasts on YouTube. The problem is they're the audio version, and they've always should have been this video version ever since we started doing these Facebook Live pages. So do us a favor also when you get a chance, as you're listening to this podcast, if you want to see the video portion of it, we do a video of the show every day because we do a live feed on Facebook. So again, typically if our schedule's on track, we do these podcasts 2 or 3 days a week. And you could download the podcast anywhere. Just go online and type in Real Estate Radio Live. You can find the podcast to download, but also visit the YouTube page at Real Estate Radio Live, and that's a lot of fun. We have some great guests in studio on a regular basis. We do the show in the studio, and again, unless there's some technical difficulties, which there are sometimes, we do the Facebook Live feed, so that gives us the video content as well as the audio. So we're going to convert all those and get those on YouTube here over the next couple of weeks. All right, so our topic today is consumers don't trust their mortgage lenders. So who do you trust? There was a report that came out the last couple of days, I think it was August 2nd, that I'm referencing here. And, you know, just like every industry, they survey customer service, customer care, what people think in general, and overall, consumers don't trust mortgage lenders and banks. They just don't still. It doesn't surprise me. I've been in this business for almost 20 years, and the satisfaction rating is low. And what does it say here? J.D. Powers found that overall satisfaction with mortgage servicers, I should say, is 777 on a scale of 1,000-point scale, which falls just below life insurance. J.D. Powers' study was based on a survey of more than 7,500 responses from customers who originated or refinanced more than 12 months ago. So this doesn't surprise me, and this is what's interesting about the evolution of technology and where it's going with a lot of some different industries, and lending is one. So lending, mortgage lending, is still one of the most frustrating experiences for people, and that's just not what I'm saying. This is what the J.D. Powers report is telling us too, is that it ranks in some of the lowest. In other words, service ratings. Now, some lenders may be on television or online and say J.D. Powers rated us the top mortgage servicer or originator in the United. But keep in mind when they say that, that's great. But what it is, it's they're saying that they're rated number one in an industry that the bar is very low. So keep that in mind. So if someone's rated number one and the bar is really low, in general, the industry has a terrible customer satisfaction rating, but you're rated number one, not to scuff it. I mean, it's still good, right? I mean, it's still good to be a leader in the industry, but keep in mind, it's a tough one to brag about to me if you say you're number one and number two on J.D. Powers on customer trust or care when the industry is really low. The bar is really low. So why is that still? Here we are in the 21st century, 2019. Technology is affecting a lot of things. And why is it that it's still such a terrible, kind of painful process to get a loan? Well, I could tell you that what shouldn't be that painful is the conforming loan amounts. You've heard me talk about this before. I've been in this business for almost 20 years, and this day and age, if your loan amount is, let's just call it $450,000, $460,000, $500,000 or less, let's just call it, which represents 70 or 80% of the United States. I'm surprised at these numbers still, at these statistics, because we do conforming loans. I don't do that many personal. Our group doesn't do that many personal conforming loans, but our company does, millions of them, a ton of them. I don't know about millions, but a lot of them. Tens of 15s of thousands a year for sure. So those are pretty easy. The reason why is there is a component of technology that's called desktop underwriting. So when in our business you get someone's W-2s, their pay stubs, their employment information, you run them into a system called desktop underwriting, DU underwriting, and typically if it's a conforming loan, they're really simple conditions, and it tells you right away whether you're approved right away. And this is why I laugh when you hear, I think it's Quicken Loans, the Rocket Mortgage ads. It's funny to me because anybody could get someone approved in 5 minutes if you have the right documents. You just can. Anybody can. So it's a great marketing program for them. I get it, and they've done a great job using it as a marketing tool. But just so everybody understands, a typical mom and pop broker shop that has the right DU underwriting and some simple technology and is set up with Fannie and Freddie and some of the government agencies, they could get an approval just as quick as Rocket Mortgage can in a multi-million dollar industry and business that does 50,000 times the volume of someone else. So it's nothing magical they're doing. They're doing it on a larger scale, and it's their marketing tool, which is fine. So the reason I want to talk a little bit about that is that the perception would be when you hear Rocket Mortgage, you get a pre-approval in 5 minutes, you think to yourself, well, why is it that if I hear this advertised and I get approval in 5 minutes, why in the hell then is it some of the rating is the worst in customer satisfaction in most industries? Well, it's because there are a few factors here. A lot of people in our industry, and some aren't going to want to hear this, but that's too bad. We're here to speak the truth and speak what's real and what's honest, not just to sugarcoat things. This industry, I told you earlier when I started the show, the bar is really low, both real estate and lending. But let's talk about lending right now, as we're talking about. The majority of people that work in this industry, especially for big banks, are underqualified. They're new. They have to pay these people as cheaply as they can and low cost as they can. So they have a tendency to hire a lot of people with major banks, Wells Fargo, Chase, B of A, Citi, U.S. Bank. A lot of the major banks have a tendency to hire people with no experience, no qualification, because they want to keep the overhead cheap. And they give these people limited training. So typically they're not that qualified because, again, they're trying to keep their costs down. They pay them a lot less than a loan officer, a skilled loan officer that's been doing this for 10, 15, 20 years on their own. They pay them a lot less. And so what happens is a majority of people still will gravitate towards a Wells Fargo, a Chase, or a Citi, or someone like that because of the big name, right? The brand name. Oh, come to us. We'll get better rates, this and that. Well, first of all, you don't always get better rates at the banks. That's number one. Number two, that could happen sometimes. But here's what happens. 90% of the time you get stuck with someone that doesn't know what the hell they're doing. Most of these people in our business do not treat it like a business. You've heard me say this before, but it's true. Most people in the lending industry do not treat it like a business. And you might ask, why is that? Well, because it's the way it's set up. Unfortunately, the numbers are kind of startling, but they're true. About roughly 10% of us probably do 90% of the business in lending. And I know that sounds lopsided, but it's true. And the reason why this happens is that you have maybe 10 to 15% of this business, this industry, that people treat it like a business and do a really good job. So they get a lot of referrals. We do in our business. We get a lot of referrals. We've been doing this a long time, and people trust you. They stay in touch. We stay in touch. There's a lot to that. Now, some people could care less what the service is like as long as they keep the cheapest rate. I mean, some people will, crawl across the street with a file on their back, half clothed, sweating, if they could save $50. And that just, no matter what, that's just going to happen. But you have an industry that does not have a very good record. And so some of the reasons why is that I just mentioned. Number one, underqualified. They have a tendency to have a lot of turnover, the banks. They hire people, they train them, then these people, they start realizing, well, wait a minute, I can make more than this if I go do my own thing, or if I work for a mortgage banker or go do something else. So a lot of turnover, so you don't get very good qualified people sticking around for a long time with the big banks. And the big banks do the majority of this business. The other part of it is some of this is jumbo financing. Now, jumbo financing represents a very small percentage nationwide of lending. But in our areas, like if you take California here, our business, our team's business here, 90% of what we do is jumbo. New York would probably tell you the same thing. Southern California, San Diego counties would probably tell you the same thing. Maybe not so much San Diego. Some areas in Seattle or Oregon. But there are really only 4 or 5 spots in the United States that are saturated with jumbo financing, and we're one of them right here in the Silicon Valley. So we do a lot of it. Jumbo financing is completely different, and those that have gone through it, you know what I mean. Unfortunately, it is a more painful process than conforming. I wish it wasn't the case, but the truth of it is you have these jumbo investors that have their own guidelines, so they're all different. And so they ask for different conditions. They have different guidelines. They ask for a lot of things of the consumers that seem very, very intrusive, frustrating, and making no sense at all. Conditions. So prepare yourself for those that are doing jumbo financing. And jumbo financing, $729,000, $39,000 or more, depending on the area. Jumbo financing could be as low as, $500,000 or $600,000 in some areas, depending on the zip code in the counties where you are. But if you have jumbo financing, just be prepared. It's going to be a little more difficult. It just is. I wish it wasn't. Some people will mislead you and say, don't worry about it. It doesn't make a difference. It does make a difference. Even the best loan officers, the best people that do this stuff every day and treat it like a business, it's still a very difficult, challenging business when it's jumbo. So as I wrap this up, and we need to go into more detail, is that the main reason is a lot of turnover, major banks that represented most of this business. And when I say major banks, I'm talking about places like Quicken too. They may have been the biggest originator last year next to Wells Fargo. I think they're neck and neck. So if you take like a Quicken Loans, Wells Fargo, Chase, B of A, Citi, if you take the major, they still represent the majority of lending nationwide. And the reason why customer satisfaction suffers is because these people have a tendency to hire unqualified people, or people that may be qualified for a while, then they have a tendency to bail out, or there's a lot of turnover. That's number one. Number two, there's not a very good use of technology. What's interesting to me is, Quicken Loans is a little bit different. They, believe it or not, do a pretty good job with technology. And New American Funding, who we work with, does a great job with technology and marketing. A couple other major bankers, but I could tell you right now, even the major lenders, Wells, Chase, Citi, a lot of these U.S. bank, they are way behind the scenes or way behind the times when it comes to using technology. They just are. They're really behind the times, and things are slow. There's still a lot of paper. There's still a lot of signing, wet signatures required, which is crazy. There's still a lot of that takes place. I know some people are talking about the acceleration of the e-signing and the jet signing of title and escrow, and they're starting to test some of this and sample some of this stuff, and this actually is getting a little bit better. But in general, remember, when you close a loan, you still have to go to a title company or have a remote signer mobile notary come to your home or your office and sign all those documents. It's crazy. If you think about it, you should be able to just use a fingerprint, retina scan, or just quickly electronically DocuSign all these, right? Well, again, there's a lot of reasons why. There's privacy concerns is really the biggest thing. Privacy and technology. And, there's still a lot of issues around fraud in lending, too. And this is one of the reasons, too, technology has really taken a back seat and is slower to gain momentum, is because anytime you're dealing with these kind of large sums of money, as much as you'd like to see there's been a bunch of advancements in technology, sometimes it still makes people very, very nervous with some of the transactions with the fraud that's taking place with wire fraud and some other things that take place in this industry. So because of those reasons, there hasn't been very much technical advancement in lending. And this is one of the reasons the customer satisfaction is very low. The other one, as I mentioned, is that there's high turnover with major banks. And honestly, the other piece too, I know a lot of people are going to be upset when they hear this that work very hard and do a good job, and there are a small percentage of people that do, but this industry just doesn't care. And I know some people might be listening to this going, Joe, aren't you in this industry? Yeah, I'm in the industry, but I'm honest. I'm one of those 10%. We work really hard every day. The team that I have here, the team that we do financing together, the network, we work with real estate agents. We work really hard. We still make mistakes. Absolutely. Still have problems? Absolutely. That happens. But the difference is when you make an effort every day and you do the best you can for people, you have a better chance to succeed, and that's what we do. So we are definitely, our group here is in that 10%. But keep in mind, that means for every 10 people you approach in this industry to help you with financing, 9 out of 10 are underqualified and do not treat it like a business. Think about that. 9 out of 10 people you do business with in lending are underqualified and don't treat it like a business. Some people will say, it doesn't matter, Joe. I got a cheap rate at ABC or Wells Fargo. It doesn't matter. Yeah, the guy was a pain or she was a pain, or yeah, it took 2 months to close, but it doesn't matter. I saved $1,000. It doesn't matter. I saved $50. So for some people, that's the ultimate goal. They'll go through all kinds of pain if they can save $50, which to me is funny to me because I put my consumer hat on all the time in other aspects of industries when I buy and sell, when I do things as a consumer. And I, all day long, will pay more for something, a service or a product, if I will, and this is a no-brainer for me, if I feel like I'm being treated fairly and people are educating me and taking care of me. I will. I just will. Now, I know that's not everybody, and that's within reason. It's one thing to pay a little bit more or a little bit more to say, you know what, it's worth it to me. That person takes really good care of me. It communicates well. It makes the process easy. I could go do my job. I don't have to worry about it because I hired a professional that knows what they're doing. To me, that's very valuable. To other people, it's not. It's not a right or wrong. It's just the way it is. And it's within reason, right? I mean, it's all within reason of what you're talking about. So if it's a loan, it's either interest rate or cost related. And I'll give you an example. Some people are so hung up on the rate, and again, everybody wants to get the best rate. But remember, each interest rate comes with a cost. Let me give you an example. It's just, it could be a $400,000 or $500,000 loan. And someone says, great news, I could get you a 30-year fixed at 3.875, and we're just making this stuff up as an example. And let's say at 3.875 at 0 points and standard closing costs, it's again, apples for apples, let's just say it's all equal. Your payment's going to be $2,500 a month, right? And then lender B says, oh, wait a minute, I could do the same thing at 3.75. And the person comes back and goes, well, look at what so-and-so's doing for this. The bottom line is the payment might be $23, $25, $26 a month difference. You might be paying more closing costs, but it's funny how some people automatically get hung up on the interest rate and they don't dive deep and figure out what the costs are. So be very careful when you're quoted an interest rate. This happens all the time. Keep in mind, you've heard me say this before, what you hear online, on the radio, some of these podcasts, right, if they're out selling mortgages or call 1-800 right now immediately to get cash, all that stuff. If that's the model, there's nothing wrong with it. But keep in mind, the reason why they call it marketing is you have to try to get phones to ring, you have to try to get emails to buzz, and you have to try to get texts to go, right? So the way you do that, unfortunately, is you do misleading advertising. A lot of online lenders, whether it's on TV, online, radio, a lot of them will do misleading advertising. Don't you laugh when you hear the disclaimer on the radio? Am I not the only one that laughs when the guy talks at 1,000,000 miles an hour and you can't even understand what he says? But he's doing a disclaimer because they have to by law, right? And you don't know what he's saying, but what they're saying is, and you would never be able to figure it out because you can't understand it, it's too fast. It just covers their butt. It covers their rear when they make these false claims. So be very careful when you're listening to these ads or someone's telling you there's an interest rate, because there's a cost to every interest rate. That old saying, if it sounds too good to be true, it probably is. That happens in our business all the time. People reach out to me and say, Joe, so-and-so said they could get this rate that's a quarter better than you're quoting. And I always say the same thing. I said, that's great, but let's double check something. Do me a favor, ask him for the loan estimate, he or she. Have them give you a detailed closing cost loan estimate. Send it over, and you and I will get on the phone or sit down in person and go through it. Let me just tell you, 90% of the time, almost without fail, when you look at the true cost of the loan, they're advertising an interest rate or verbally telling you there's an interest rate that sounds too good to be true. And then when you open the hood and you get into the details, the reason why that rate's so good is because they're charging more cost. They're charging you a point or origination. In other words, they're making it sound really good without telling you the costs associated with that rate. Be very careful with this. Someone says, you hear the market rates at 3 7/8, and someone says, I get 3.5. I'm getting people 3.5, and you get all excited. And what you need to do when someone says, I get 3.5, say, well, okay, that's great. What's the cost at 3.5? And if they fumble around and they don't quite answer you, there's a reason for that, because this is called marketing. They're misleading people through marketing tactics. It's not illegal, unfortunately, because there's this disclaimer in there. They're talking 1,000,000 miles an hour, or it's at the bottom of the page, 3 paragraphs long, and it's really tiny and you don't understand it. And I'm just refreshing everyone. The reason I'm bringing this up is that we're in an industry that's really busy right now. Rates are low, so there's a lot of refinance business, and I'm going to get into that in a couple minutes. I'm going to shift gears a little bit. The purchase market's starting to heat up. I've been talking about this for several months. If you listen to these podcasts, if you've been following my podcasts, I've been telling buyers, get out there, and guess what? This market's starting to change. It is officially starting to change, and I wouldn't be a bit surprised. Let's see what happens, say, come September, October. It'll be interesting to see if this switches to a seller's market again. It really will. It'll be interesting to see. And I've been saying for 6 months at least, if not more, get out there, buyers. Get out there, because it's a great time. Don't let yourself get sucked in and stay on the sidelines and worry about prices coming down a little bit, because when the market switches, it's too late to time it. You can't time it. And I'm telling you right now, what I'm seeing in the industry and the market, and again, I'm talking about Silicon Valley, I am telling you in the last 2 weeks, or so, I have seen the market change. And what I mean by change, I have seen things heat up. What do I mean by that? I am starting to see homes going for more than listing price, multiple offers again, 10, 15, 20 people putting offers in. It's starting to come back. Is it going to come back full force? I don't know. I can't tell you that. But what I can tell you is, I hate to say I told you so, I have been preaching this for the last 6 to 8 months for buyers to get out there, because I was concerned that this may turn back into a seller's market again. I'm not sure that it'll turn back into a full-blown seller's market, but I can tell you right now, as of today, as of yesterday, it is now becoming a little more difficult for buyers to get their offer accepted, when just a month ago, it was easy. Just a month or two ago, most people, if you put in a realistic offer, you'd get it accepted. And you might even be able to get a deal with contingencies attached to it. Right now, it's starting to change a little bit. Is it going to happen overnight? No, but it'll be interesting. And I don't say this to scare people or alarm you to jump out of your seat and go ahead and buy a house if you're not ready. What I'm saying is, this is where the education comes in. Education and information when you're following a market, when you're either getting ready to sell a home or buy a home or both. You should keep an eye on this stuff. You should follow, whether it's our show or anybody else's show, anybody you trust or someone that follows the market and has their finger on the pulse, which we do. So I'm going to finish the show in the last couple minutes and just talk about how important it is right now for a couple different things. There's a good chance that the summer, maybe, it's so hard to tell, but let's call it summer of next year. We could be looking at a recession. Really hard to tell. With some of these tariffs, what's going on with trade and some of these other things, we could be looking at a recession. I know a lot of people don't want to say that or talk about it because the economy's, steaming ahead right now. But the Fed's looking to lower some of the rates. There's some unrest right now globally. So the reason I bring this up is take advantage right now. These are the things the point I want to get across before I close out today. If you're in the market to buy or sell a home, get out there and do it. Do it this year. It's a great time. It just really is. Next year, there's going to be some uncertainty in the marketplace. If you're looking to remodel, do an add-on, if you need cash to pay off debt or to do something, do it now. And the reason why I encourage you to do it now is a couple of reasons. One, record low interest rates. Okay, but two, just as important, the value in your home has probably not been this high since you've owned the home. If you've owned a home for 5 years or more, you're probably seeing the value of your home higher than it's been since you've owned the home. Really good chance. Why do I bring that up? Is because that's buying, that's leveraging, refinancing, that's lending power. Anytime your home is more valuable, you're going to get better terms, better rates. You have better lending power. You have more leverage in your lending. And the reason why that's important, if we do get into a recession sometime later next year, and it has an effect on the housing market, and your house today is worth $1.5 million, and we go into a recession and your house is now worth $1.2, $1.1, again, I'm not saying that's going to happen, but you have less lending power then. So if you're planning to do anything on a remodel, a cash out, pay off debt, pay off a first and second, pay off student debt, get that addition, maybe build one of these accessory dwelling units on your property, anything like that, do it as soon as you can with these combinations of things going on, because it's going to get a lot tougher next year depending on what happens with the rates. And if we look at some unstableness in the marketplace and we look at some potential recession, it could get interesting and not in a good way when it comes to housing. So this is not meant to alarm anyone. This is not meant to scare anybody or be this alarmist, but it's just, if you've been following my show for years, you know I educate and inform. I educate. So I pass this information along that I study on a regular basis to help you, the consumer, make decisions in and around your real estate. So keep that in mind. So as we close out today, again, be very careful who you work with, whether it's a real estate agent or lender. I talked a little bit about customer satisfaction. The mortgage industry is terrible. I'm in it, but I've been in it, but I'm a realist. So more importantly, be careful who you work with and someone you could trust that's going to take care of you. Number two, great market right now. I'm concerned that it could be maybe pivoting back towards the seller's market, so those buyers get out there. If we could help you, remember, that's what we do. We help people finance here. We have real estate agents on our network. We have everybody, anything to do with real estate, we could help you. Give us a call, check in, let us know. You need financing on a purchase. You need financing to refinance. You need a consolidation. Do you need the strategy of how to buy a home before you sell a home? All that stuff, we're here to help you with any of that. So check in and let us know. Again, this is Joe Kuchera with Real Estate Radio Live. Thank you again for tuning in today. Thank you for those that are following us on Facebook. And remember to check out our YouTube page. We're updating that, and should have most of those videos online up and going here in the next couple of weeks. Take care. Have a great afternoon.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.